Hello friends, in this lecture we are going to discuss the determination of interest rate. As you know, interest rate is monetary phenomena which occurs in money market. We have studied this in ISLA model, that how rate of interest is determined in money market, right? Here we are going to discuss specifically the determinations of interest rate exclusively as part of money market. We have already discussed in one of our lectures on what you call concept of money, types of money, then functions of money, etc. Right? In continuation of that, our analysis will remain incomplete if we do not study the determination of interest rate in an economy. Interest rate is very crucial for the economy because it is going to decide the functionings of the financial market. It is going to decide the functioning of goods market. It is going to decide varieties of economic activities in the economy. This particular chapter on interest rate determination here that we are going to discuss primarily arises on the basis of chapter on financial market in a book on macroeconomics by Oliver Blanchard. Since I'm discussing this here, that particular book, because this particular chapter has been referred as part of reading in introductory macroeconomics generic elective paper, which is offered to the second semester students of Delhi University, right? So let us discuss the concept of interest rate determinations, right? Now, when it comes to determination of interest rate, you come across varieties of interest rate in the economy. When you go to the bank, you deposit your money as FD, right? You get certain rate of interest on that. Similarly, when you go and take loan from the bank for the purchase of house, there also you have to pay certain rate of interest on taking loan. When you go and take loan to purchase any durable products, right? There you have to take loan, and then you have to pay certain interest rate. So what you have, that the interest rate arises whether you are taking loan or whether you are depositing your money. Interest rate arises whether you are investing your money in a bond which carries certain rate of interest, right? So similarly, as let us say you have your own company and you want to raise funds from the market, and you follow bonds market to raise the funds from the public, right? To have money to start your business, right? Or to expand your business. There also you offer certain rate of interest on the bond to make it popularized among the public, right? So rate of interest arises only when you are taking money from someone, or you are giving money to someone, right? Of course, this particular discussion assumes that you are not doing any charity while giving money, right? Your purpose is to make some economic gain out of this monetary transactions, right? Now, in this context, we need to understand that what is rate of interest, right? What is rate of interest? Now, in very simple way, the interest rate is defined as the price of money for parting with the money for some period of time, right? So the way you've got price of goods and services, which you pay when you're going to buy those goods and services in goods and services market. Similarly, here also, when you take loan, right? That means you are taking someone else money, right? Or you are giving loan, or you are depositing your money. That means you are parting your money with someone, right? On that, there arises what you call certain price, which we call rate of interest, right? So therefore, we call the rate of interest is nothing but the price of money, right? Rate of interest is nothing but the price of money for parting your money for certain period of time, right? Because when we buy goods and services, right, when we pay the price, we have full command over goods and services. But here, in case of money, what happens that when you borrow money or you deposit money, right, uh, uh, in case if you are borrowing money, you pay certain rate of interest with the conditions that in future you will have to return the money that we have borrowed. Similarly, when you have deposited money, you get certain rate of interest on that with assumptions that in future you what do you call you will withdraw money or you have right over that deposits, right, which has been created by parting money with bank, right, or with anyone who accepts the deposits, right? So that is how the rate of interest defined simplistically, right? That the rate of interest is nothing but the price of money for parting it with someone else for certain period of time. Similar to these definitions, in fact, Keynes also said in 1936, and that differs from how classical economics defined rate of interest. Classical economics defined rate of interest as nothing but the price of loanable funds, but here Keynes defined rate of interest as the reward for parting with liquidity for a specified period of time. Therefore, the rate of interest is the price which equilibrates the desire to hold wealth in the form of cash with the available quantity of cash. So in fact, rate of interest is going to decide in what proportion you want to hold your wealth in the form of money and non-money, right? And it is the rate of interest which is going to equilibrate the money demand and money supply, your desire for cash and the supply of cash. This is how the rate of interest is determined in the Keynesian model. Here, the rate of interest is the price which equilibrates the desire to hold wealth in the form of cash with the available quantity of cash, which means the rate of interest is the mechanism through which the demand for cash and the supply of cash are equalized, right? So this is what your rate of interest is. Now, when it comes to determinations of rate of interest, uh, we have got two forces which determine the rate of interest in the economy. One is called the demand for money, and another one is the supply of money. So it is the demand for money and supply of money are the two forces which are considered very important factors in determining the rate of interest in the economy. Right now, as far as rate of interest determination is concerned, as per the macroeconomics book by Oliver Blanchard, there are two cases. One case where there is no presence of commercial banks, and other case where there is presence of commercial banks. So the first model where we discuss the determinations of interest rate is very simplistic model, but it helps you to understand the process of interest rate determinations. Once you are able to understand this process of interest rate determination in the absence of commercial banks, you can easily understand the determinations of interest rate in the presence of commercial banks. So there we have got two models of interest rate determinations, one in the presence, one in the absence of commercial banks, and other in the presence of commercial banks, right? So let us first discuss the interest rate determination in the absence of commercial banks, right? Now, as far as what you call uh, the first case of interest rate determination in the absence of commercial bank is concerned, there the money exists only in the form of currency, right? Money exists only in the form of fiat money, right? Which has been created by the central bank. Okay, now given that concept of money, uh, uh, we now look at that, okay, what is the demand for money, right? So as we have already discussed that It is the demand and supply of money, right? Two forces which determine the rate of interest. So first we need to identify that what is demand for money, right? We need to understand what is demand for money, right? Now, as far as demand for money is concerned, right, as per Keynesian principle, and also if we include the post-Keynesian economics with respect to money demand determinations, what we find that there are two factors which determine uh, uh, money demand, right, which play a role in determinations of money demand, right? Partially we have discussed this issue in ISLA model, but to recall that or to reiterate that, we again say here that money demand is dependent upon two factors, two economic components. And what are they? One is called income and other is called interest rate. Now, how those factors affect, that means how income and how interest rate affect what do you call the money demand, is what has been discussed by Keynesian and post-Keynesian model of what do you call or theories of money demand, right? Now, according to Keynesian theory of money demand and post-Keynesian theory of money demand, uh, income plays very important role in determinations of money demand, right? The logic for this is that uh, what do you call, as your income rises, right, you tend to consume more goods and services, right? Now, when you tend to consume more goods and services, right, you require more money in your hands to make the transactions uh, according to your requirement, right? So as income rises, you consume more goods and services, right, and therefore you require more money, you require more cash, right? So what do we find here? That your cash requirement varies according to variation in your level of income. That means if the income goes up, right, the money demand goes up. If the income goes down, then the money demand also goes down. Remember here that Keynes talked about two types of demand for money. Rather, he talked about three, but the two are specifically related to level of income, right? That and those two types of demands for money are called transactions demand for money and precautionary demand for money, right? Both types of demand for money are meant to take care of day-to-day known transactions related to your consumptions and unknown transactions which can arise in emergency or in contingencies, right? So these two types of demands for money are directly positively related to level of income. That means if your income rises, right, your transactions and precautionary demand for money also rises. If your income falls, your transactions and precautionary demand for money also falls, right? So here money demand is positively related to income. However, Ken said that holding cash is not costless, right? Of course, holding money gives you convenience to make transactions smoothly, right? But holding money can also lead to some cost or some loss to you, which might occur if there is presence of some non-money financial assets, right? And since we have no banks in this model, so we are assuming that only alternative financial alternative available to you to hold your wealth is bond apart from money. So if you don't want to hold money, right, then you can hold bond, right? So that means you have your wealth being maintained in two forms, money and bond, right? Now, when you are holding bond, that means you are minimizing the cost of holding money. Why you are minimizing the cost of holding money? Because the bond is characterized by certain rate of return certain rate of interest, right? So as long as bond carries certain rate of interest, holding money will have some positive cost for you, right? As rational individual, you would like to minimize the cost by holding less money if the return from bond is higher. If the return from bond is lower, then you would like to maintain your wealth in the form of money. Remember that the money is completely risk-free financial assets. There is no risk associated with that. On the other hand, bond carries certain risk. So therefore, bond must offer a substantial amount of a substantial rate of return which can encourage you to take the risk and hold bond and reduce the holding of money. So what do we find here? And this kind of relationship between the money demand and rate of interest is called as speculative demand for money by Keynes, right? So if you look at overall money demand theory given by Keynes, right, and even the post-Keynesian economics, what we find that the money demand is positively related to income but negatively related to rate of interest. And why negatively related to rate of interest? Because holding money, right, cash holding in your pocket has got certain cost, and that cost is nothing but foregone interest return by not holding bond, right? So the existence of bond has got certain repercussions as far as your gain or loss on holding money is concerned, right? So that is how your what you call money demand is defined in this model, that money demand is positively related to income and negatively related to rate of interest, right? And this particular relationship has been expressed very simplistically in equation 1, which says that MD is equal to dollar $y into L in bracket I, and there is minus sign below this I, right? What? How do you read it? You can read it here that MD is the nominal demand for money, right? It's the nominal value of cash that you are holding in your house, in your pocket, right? Now that is positively related to that dollar income. So here dollar Y is basically nominal income, right? So if we take economy as a whole, what we find that the MD stands for the total cash held by the individuals, right? Which depends upon the what you call uh, nominal income in the economy, right? And this MD is what you call has got some relationship with the rate of interest, and that relationship is characterized by negative relationship, right? And that is why we have got minus sign. So it tells you that as interest rate rises, right, money demand falls. As interest rate falls, money demand rises, and that is why we have got negative sign over here, right? So this is how your money demand function is described. Remember that in ISLA model, our money demand is expressed as KY minus L, KY minus HI. But here, the same money demand function is being expressed as dollar $y into LI, right? So this amount of LI is nothing but a fraction of total income, right? A fraction of total income, okay, which has been expressed by K in what you call money demand functions given by Keynes. And you can also visualize that this LI is nothing but K of money demand function of what you call Cambridge version of demand for money, right? So this is how your money demand function is uh, 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 expressed. Now here this LI basically shows the functional relationship which measures to what extent the money demand responds to change in interest rate. The negative sign highlights the negative relationship between MD and I that we have discussed. Then the money demand function highlights that the rise in nominal income will lead to rise in money demand, and according to that expression of relationship between the money demand and income and rate of interest, right, which has been expressed by equation 1, we can say that if y rises, money demand rises. In other words, if y doubles, it becomes 2y, then MD also doubles, right? Now, however, the value of LI, right, which is fraction of total income, okay, which is nothing but expressed as K in traditional money demand function as per Keynesian model, right, is what expressed here as MD upon dollar Y, which means that for given dollar Y, right, the ratio of MD and dollar Y is fixed, and therefore LI is a fraction of what you call dollar Y. Okay, so this tells you that for given level of interest rate, as income rises, money demand rises. As income falls, money demand falls. But on the other hand, for given level of income itself, right, if interest rate rises, what will happen? If interest rate rises, what will happen? MD will fall and LI will fall. On the other hand, if interest rate falls, MD is going to rise as proportion of dollar income, and therefore LI is also going to rise, right? So here LI basically shows the fraction of total income which arises on account of what you call rate of or given rate of interest. Okay, so if the rate of interest rises, the value of LI falls, and if interest rate falls, value of LI rises. So basically it tells you that what you call, if rate of interest rises, then the cost of holding money rises, and therefore you would minimize the cost of holding money, right? So you would hold less cash, less money, and hold more bond, right? And that would reduce your cost of holding money, right? Definitely you are compromising with your transactions for goods and services, but then since there is higher rate of interest, right, so you would like to happily sacrifice the current consumption and maximize your consumption in the future time, right? So this is how your money demand in other words, this is how your money demand or cash holding decision is influenced. One is by income and other is by rate of interest, right? Now once we have discussed the money demand function in the economy, right, we can also discuss the other side of market, that is your supply of money, right? And the supply of money, as we know, is the prerogative of the central bank. If the central bank is very happy and does not have any concern about the inflation, it can raise the money supply in the economy. And if it wants to reduce money supply, if it is very unhappy with the inflation rate, then it can reduce the money supply in the economy. So it's purely prerogative of the central bank, and therefore in this model we consider money supply as exogenous, money supply as given. Now, how is the rate of interest determined in this model of money demand and money supply, right? In the absence of what you call commercial banks, it's the money demand and money supply. These two forces basically determine the rate of interest. So this thing we can explain through a diagram, right? And in this diagram, we have what you call interest rate on what you call y-axis, and money demand and money supply along with x-axis, right? And this is the origin. Now the money supply is fixed because it is the prerogative of the central bank. So we assume in this model that, let us say, the currency in circulation is fixed by the central bank and it is given at MS level, right? So the money supply line will be vertical here. And what about the money demand line? The money demand line as we know, uh, reflects the money demand function. Money demand function tells you that money demand is positively related to income and negatively related to rate of interest. So here we can find out the relationship between interest rate and money demand for a given level of income, and we get the downward sloping line. We get the downward sloping line, which tells you that as interest rate falls, money demand rises, and when interest rate approaches lower amount, right, then money demand becomes in some way infinite, right? So nobody wants to hold any bond because the rate of return from the bond is very low, and given very low rate of return from the bond, no individual wants to hold any risk, and it wants to hold all all his or her wealth only in the form of money, and therefore there is huge demand for money at very low rate of interest. So this is how your money demand line is derived. Okay. uh, so uh, wherever there is equilibrium, we get the equilibrium rate of interest. So this is how your rate of interest is determined in an economy, right? In a money market, that money supply and money demand, these are the two forces which determine the rate of interest, right? Now this I naught rate of interest is occurring as E naught, and E naught is that point where money supply is exactly equal to money demand. That means money market is in equilibrium, and therefore I naught is the equilibrium rate of interest, right? In case if rate of interest is below I naught, then you will have a situation where money demand is greater than money supply, right? Money demand is greater than money supply. Now to balance money demand exactly equal to money supply, the rate of interest has to rise, right? On the other hand, if the rate of interest is above I naught, right? Suppose it's here, then that will lead to what? That will lead to a situation where money supply is in excess of money demand, and to have equilibrium in the economy, money demand must rise so that it reaches to the what you call point E naught at equilibrium point, and for that rate of interest must fall so that the money demand rises, right? So this is how your rate of interest determined uh, in an economy uh, in the absence of commercial banks, and only in the presence of central bank, and only in the presence of fiat money. There is no other form of money. Now what will happen to the rate of interest if the money supply in the economy rises, right? Obviously when money supply rises, your blue line shifts rightward, it becomes the red line, because I mean the money supply in the economy has increased, and money supply in the economy has increased to the MS prime level, and that causes what? That causes fall in the interest rate, and we get now I naught prime rate of interest, and equilibrium sits to E naught prime, right? So this is how your rate of interest determine what you call uh, in money market uh, in an economy. This is what I had to discuss with the concept of determinations of interest rate. I hope it is clear to you. Thanks a lot for watching this.